Hello, everyone. I'm Jeff Sarti, CEO of Morton Wealth.
And I'm Meghan Pinchuk, Chief Investment Officer, Morton Wealth.
Today, we're going to be discussing our quarterly market review. And actually, we're going to be looking backwards at 2024 and what happened last year. But also, we're going to talk about 2025 and what to expect in the year ahead. But before we go there, I just wanted to quickly acknowledge everything that's happened in recent weeks with the local fires. Really devastating what's happened. We had a handful of clients and actually one teammate as well who lost their homes. Our hearts go out to you. For all of you and for anyone who's been affected, or even for those who have loved ones that have been affected or friends and family, please don't hesitate to reach out to us. We're a resource, and we'd really be more than happy to help in this time of need. All right, so with that being said, let's talk about 2024. Let's start with stock market performance.
This is the highlight or the most exciting part in a lot of ways.
Yeah.
So the S&P 500 was up 25%. So a big year, even by historical standards.
And that was after last year, where it was up, I think, more than 20% as well in 2023.
Yeah, so now you're looking at 2 years running where it's been really strong stock market performance. As with previous periods, it did mask a little bit the S&P 500 headline performance, masked a little bit of the underlying, which was that the broad market did well, but not quite to that degree. So the equal weighted index, where you just take those 500 stocks and say each position gets an equal weighting, that was up about 13%.
That's a huge discrepancy, 25 versus 13%.
It's a huge discrepancy versus and then this year had some of the biggest discrepancies on record between things like growth stocks and value stocks, large companies and small companies since the dot-com bubble. So some really big spreads between kind of what the biggest companies did and then what the rest of the market did.
Well, okay, and that's interesting. Not a great market to be compared to the late 90s dot-com bubble.
Yeah, if you're gonna pick something to compare to, that probably wouldn't be my first choice. But so in the sense too, what we have a narrowing of the market also, where the market, instead of being, again, a broad, you think, the S&P 500, diversified 500 stocks, it's almost 40% of the index, like getting close to that.
What specifically? The top 10 stocks?
The top 10 stocks, almost 40% of the index.
It's incredible concentration.
Versus it was in the high 20s in the dot-com bubble, which was also an extreme, from a historical standpoint. And then you kind of even scarier in some ways, the top 3 stocks, almost 20% of the index.
We're talking about Microsoft, NVIDIA, and Apple.
Correct.
So 1/5 of the index, just in those 3 stocks.
Yeah, so really just some of those things that are indicators sometimes of more speculation or more just markets narrowing, things that historically have been challenging. We're seeing a lot of that now.
There are a couple of other concerning signs that I just wanted to point out. And we typically don't really talk much about short-term data, but there were a few short-term things that happened specifically in December that were real outliers that at least shouldn't be ignored. Couple things. One is, you mentioned the S&P 500. That did well throughout the quarter, but other stocks did not do well. Right. There's another index called the Russell 2000 index. That's 2,000 smaller companies in the S&P 500, still very large public companies. That index in December was down 14 days in a row. That's the longest streak in history. Never before have we had such a long streak.
And so that's not a drawdown to recovery. We've obviously had longer periods where the market took to recover, but it's an interesting concept of usually even during bad periods and then it comes back, there's positive days in there. So this was a long stretch of just loss after day after day.
And it wasn't just the small cap companies too. The Dow Jones index, many people are familiar with that index that's been around forever. 10 straight down days in December. That was the longest down streak in 47 years. Yeah. So again, just not great signs. You mentioned breadth or broadness to the market. Very narrow participation in terms of what was working and what was not working.
Right. Yep.
All right, so that's kind of backward looking. Now as we look forward in terms of our expectations around stocks, so much of it comes down to valuations. And we spent a lot of time talking about valuations in real years, and stocks are expensive. And by many metrics, we would say extremely expensive. By certain metrics, the only times that stocks exceeded the current valuations in terms of price to earnings ratios, price to sales ratios, things of that nature, was the dot-com bubble. So definitely a very expensive stock market. Now, when we think about forward-looking returns, and we're not talking about the next 1 or 2 years. We have no crystal ball with regards to the next 1 or 2 years. But let's say 10-year forward-looking returns. Typically, the most reliable predictor of long-term returns are starting valuations. Meaning when stocks are cheap, typically the forward-looking returns are very strong.
Right.
And vice versa, when stocks are expensive like they are now, forward-looking returns tend to be poor. And so that's just not us saying it. Wall Street at large has actually come out with some of these reports of late. So a few examples. Goldman Sachs just came out with their forecast of 10-year returns, and they say their best guess is stocks will return 3% annualized over the next 10 years. Pretty low. Yep. Vanguard, another mega company out there, their forecasted returns, they gave a range, basically roughly 2 to 5% per year over the next 10 years. And then lastly, which I just read the other day, Morgan Stanley, they didn't come out with a number, but their chief investment officer came out and he said that he expects returns over the next 10 years to be roughly flat. So really not really a rosy picture for forward-looking stock returns.
I do think it's important, the context of the short term, you hit on this, but like, we don't have a crystal ball. These companies don't have a crystal ball. I don't think anyone knows this year, does stuff continue getting more expensive? Do you have a third big year in a row in terms of stock performance? It's very possible. Where valuations do come into play is in the longer term stretches. Again, valuations are probably the best indicator of longer term forward returns. Mm-hmm. But in the short term, there's really not a great indication of what's going to happen this year.
And maybe just give one just simple example with a company that everyone knows, Apple. Apple's a company that we have talked about in the past. And Apple is a great company, right? Incredible products. We all love the company. But what makes a great company does not necessarily mean makes a great stock. And again, I'm mainly talking about valuations. Apple currently is trading at a 35 to 37 price to earnings ratio. By way of context, historically speaking, Apple typically trades in the low to mid teens in terms of a price to earnings ratio.
Not cheap.
And Apple's not a growing company. Again, it's a wonderful company, but its growth has been fairly flat over the last 2 to 2.5 years in terms of its revenue. So typically when you see a price earnings ratio that high, it's justified by a very high growth company. Not the case with Apple. Apple's currently trading at a $3.5 trillion market cap. I mean, just astronomical numbers.
I feel like it just crossed the $1 trillion mark. Everyone had a party.
It was the first $1 trillion company. That was back in only 2018, so only 6 years ago. It's basically quintupled in value. But again, it's not like it's grown by anything to that same degree.
And so I think that disconnect between what's happened with the stock price and then what's actually happened with the fundamentals, that's where I think there's concern that there's a lot of speculation going on, is that people are bidding up the price. And you've seen that. So like I said, we've seen that in stocks, certain indicators that stocks are getting ahead of themselves, but it's in other asset classes as well. Bitcoin was one of the best performing asset classes last year.
Crypto in general just had a big year last year.
Yeah, and so separating almost those for a second, because Bitcoin is a little bit, I would say Bitcoin is unique within that grouping, but crypto broadly went crazy. Yeah. And we think is very much a sign of speculation in these markets. And so a great example is a new coin that got created.
I know where you're going.
Do I have to say it, or are you going to say it? Fart coin was created in October.
It's not a joke.
It's actually, well, it sort of is a joke, but it was created in 2024.
Just in October.
October of 2024. And it's worth now, it's got $1.5 billion market cap. Yeah. So something created out of thin air and being bid up by a lot of this speculative fervor around cryptocurrencies.
Just one other side note of that. We're a few days after the inauguration when we're recording this. President Trump just issued a Trump coin, which just 2 days ago, the valuation was north of $10 billion. They have a Melania coin, valuation I think at $2 or $3 billion. I mean, these are signs of tremendous enthusiasm and sort of speculative excess in the market. We have concerns about that.
And look, the reality is, because we've gotten questions about Bitcoin as well, and I think that is different in the sense there's been more adoption, there's longer history on that, though still not newer relative to the scheme of things. It's hard to get excited for us about Bitcoin, given that it is lumped into, I think, this crypto world. Right. We like a lot of the fundamental principles of it, more aligned with gold, for example, which is something that we use to deal with some of the concerns we have around like dollar debasement, money printing, and things like that. And so I think Bitcoin has some of those elements that we're watching and we find interesting, but as it's sort of being bid up with the speculation, how much of it is kind of fundamental demand, how much of it's speculation at this point in time?
It's really hard to measure.
It's really tough.
Right, especially when you have all these other coins that are fundamentally, we believe, ultimately worthless, that are just going to the moon. How much of that Bitcoin price is the same dynamic.
And so we do have our gold allocation, though, which again, we has a lot more history in terms of something that we feel like we can rely on to serve this purpose in portfolios.
Yeah, so gold has been an allocation for us for a number of years, actually going back to 2015, and it's been a very strong performer for us. Last year had a very good year. It was up 27%, actually even outperformed stocks by a little bit. You kind of talked about the rationale for gold, and we won't spend a lot of time here because we've talked a lot over the years about why we own gold. Again, it's an alternative currency, a store of value against debasement, inflation, et cetera. But one of the things I wanted to point out is what's caught many by surprise in the last year or two is that gold has done well in a higher interest rate environment, which has caught people by surprise.
Yeah, that's not, historically hasn't been the case.
And what I mean by that is, let's think of owning just a US Treasury as an alternative. If you wanted a stable currency, theoretically, you buy the dollar, right? And you buy a treasury bond, and you can make a 5% yield. So all things being equal, why not just buy that treasury bond and make a 5% yield versus owning gold, which yields nothing. Right. And that's the fact that gold's doing well in that environment. It's telling you something. It's telling you that at least gold investors are saying, you know what? That 5% yield in a treasury bond where you're paid back in dollars, that's not compensating you enough theoretically for that debasement and inflation risk. Right. And gold theoretically will do better than that. So shifting gears, let's talk about another real asset, real estate. We obviously have a lot of history and experience in real estate. What are your views on the real estate market?
The last year, and even since I would say post-2022 when interest rates started rising, has been a different paradigm for real estate than it's been for a while. I think if clients or people listening if most of their real estate exposure or experiences in their homes, it's actually a very different feeling or what's happening than I think the broader investment real estate market. Because look, in Southern California here, home prices
still at all-time highs.
All-time highs, and you would have thought there would have been an affordability issue, that mortgages rates going up would have really affected that, but there's been such limited supply on the market that anything comes up, it gets bid up and kind of taken very quickly. So the home prices have gone up. That's been a good performing sort of segment of the market. So broader investment real estate has had a lot more challenges. And that, I think, is to be expected related to what happened with interest rates.
And when you say broader, you're talking about apartment buildings, storage facilities.
Yeah, industrial properties. So anything more of those investment types of real estate. And so I think that what we've seen is there's sort of a bit of a dichotomy going on where there are certain properties, if they were to call it mid-construction, if they didn't have permanent financing yet, so they had to go out and get a loan at a higher rate, where costs have really gone up materially, and certain markets, depending on where you are, real estate's very location specific, have softened. And so there are definitely properties out there with more fundamental challenges. I think long-term, if you're in the right segment of the real estate market, if you're in apartment or industrial, the long-term trends and demand will be there, but can you ride it out and deal with some of these increased expenses, short-term? There's definitely pockets of that, again, fundamental issues. The other part of the real estate market, which is where I think we have a lot of exposure, is you've got properties that are solid properties. They're stabilized, they've got good occupancy levels. They often have fixed rate financing at those lower rates. The income is still growing, and so they're in good shape. But even those properties last year actually priced down from just in terms of what was it worth, right? Interest rates are higher, it's worth less because real estate is so interest rate sensitive. So that's something we look a lot at, is even in the existing portfolios. If there are challenges or whatever with the pricing, is the cash flow at least consistent, or is it growing? Are there those fundamental challenges, or is it fundamentally healthy?
So can you talk then, is that resulting in some opportunities?
Well, we're waiting. We're very open. We've been looking at we see so many deals across our desk. And what's interesting is the deals we're seeing now, they are more attractive than they were pre-rates rising, but
not that much.
Not to enough of an extent, I think, for us to be excited. There's a lot of talk that as properties need to be refinanced, there will be a lot more coming to market. But I think to a large degree, we're still seeing a disconnect between buyers and sellers. Sellers are trying to hold on and hope that rates fall and kind of rescues them. And buyers are waiting for really good deals. So if one of those comes to pass, if there is a dislocation, I think we would be really excited to participate. But until then, we're being patient.
All right, so let's shift gears a little bit. We talked about stocks, we talked about commodities, real estate. Let's talk about bonds.
Bonds are actually exciting.
Bonds have become more interesting. We've had a rising interest rate environment in the last few years. Because of that rising interest rate environment, bond performance, typically speaking, has been really challenged. Yes. Tough few years. Last year, the bond index was only up 1%. our bonds, and we'll talk about it in a little bit, did much better than that. We avoided a lot of those rising interest rate risks. But a real challenging bond environment since interest rates started rising about 3-ish years ago. Quick stat on that. The drawdown in terms of the broad-based bond index is 53 months and counting. So what I mean by that is if you bought the bond index over 4 years ago, you would still have a negative return 53 months later. Yeah. I'm talking total return, price plus the income you received. That's the longest drawdown in bond market history by far. The previous record was only 16 months back in the early 1980s.
And it makes sense, the 80s at least, right? That was a very challenging period in terms of interest rates going up, but you were getting paid back then. The yield was much higher, so it helped to cushion some of the downside. Here, I think you don't have that, and we've been concerned for some time that you're basically just not getting paid for having that kind of exposure to those types of price fluctuations. I think now what's happened is with rates coming down recently, I think a lot of bond investors were saying, okay, it's going to get better, the Fed's going to lower rates. And we saw something really fascinating, which is that the Fed came in, they lowered rates.
By 1% over the decent amount.
It was a decent sized move, and you actually saw yields rise. And what I mean by that is the Fed only gets to control the short-term rates. They don't get to control the bond market. The bond market is much bigger than the Fed. Yeah. And so you saw, again, the Fed lowering rates and interest rates in the broader bond market actually increasing. Meaningfully. And then it became this question of, is the bond market basically telling us enough's enough?
And let's talk a little bit more about that. Like, in essence, when you expand on that, when you say the bond market is telling you enough is enough.
An investor's looking and they're saying, what am I going to get paid, for X years to lock up money for 10 years? They're saying, I don't want to get paid 2 or 3. Like, I'm concerned inflation is much higher than that, even 4. I need to make more to basically be willing to commit to that 10-year period.
Tied to that, we've spent a lot of time talking about our fiscal imbalances, debt levels. And in 2025, we're going to be refinancing trillions and trillions of dollars of debt that's maturing and that we have to refinance. In addition, our annual deficits increase the debt by $2 extra trillion a year. So I mention that because a tremendous amount of supply of bonds is coming to the marketplace. You need buyers of those bonds. So if supply exceeds demand, that could push yields higher even further because you have to compensate bond investors
to make them willing to buy all those bonds.
Right.
I think it's a real issue. And so looking forward to 2025, we've gotten a lot of questions about the regime change, right, with the new administration coming in and how that's going to impact things. And I think some people are optimistic in the context that they look at President Trump's last administration and the stock market performed very well in that environment. But I do think the starting point they were dealing with is very different.
Yes, there is some optimism because theoretically it's a pro-growth, low regulation type of environment, which can help stock performance in the economy at large. But to your point, it's a very different stock market as compared to 2016 or 2017. And it comes back down to valuations. If you compare the valuations, let's say on a price to earnings ratio compared to back then, meaningfully higher. Stocks were not cheap back in 2016, 2017, yet on a PE ratio basis, it's roughly 30 or 40% higher than it was back then. Also going back to interest rates. We were in a very stimulative interest rate environment back then. Interest rates were basically zero.
Yes.
Now they're much higher. Also, it's a more complicated, volatile inflationary environment. So to some degree, we think everything is sort of priced in for perfection.
Yeah. So anything goes wrong, and it's potentially challenging.
Yeah, exactly.
The other thing that there's a lot of talk about is the DOGE, which I can never...
Department of Government Efficiency.
Thank you.
Yeah.
I mean, maybe just government efficiency can't come out of my mouth. So I think that there's talk about that, and they're going to come in and cut. And conceptually, I think we're very much on board.
Sure. Again, we've talked about debts and deficits for a long time, and we do applaud that finally someone is talking about these debt levels that have to be under control. That being said, when you really look at the numbers, easier said than done to really make a meaningful debt. So just brief highlight on the overall numbers. As a country, we collect roughly $5 trillion of tax revenue. That's what comes in on a yearly basis. But our expenditures, what we spend, is $7 trillion. So that's that $2 trillion deficit gap.
Right.
So what can be cut to lower that gap? When you think about the $7 trillion, it's really two main buckets, mandatory spending and discretionary spending. The lion's share is mandatory, which is really tough to cut. Some examples of that are Social Security and Medicare, both well over $1 trillion in annual spend. President Trump has basically said he's not going to touch those. The other one, interest rate expense, is now, just the interest cost of our debt is now exceeding $1 trillion a year. And that's going higher as we refinance debt at higher rates. So not much room, if anything, to cut there. So looking at the discretionary bucket, which is much smaller, about half of it is military. That's about $800 to $900 billion.
Which is possible, but in the current geopolitical environment, that would be challenging to cut meaningfully.
So basically, you have just the rest of that small discretionary bucket to play with. So maybe they'll have some success, but we think maybe they'll make a small dent, but we don't know if it'll move the needle.
Not enough to balance the, but that would be maybe outside the realm of what's reasonable to expect. The flip side of this, though, something to consider is, let's say they were successful, meaningfully cutting back spending. If you think for so many years, I think why maybe stocks have run and gotten so ahead of the fundamentals and why the economy has grown at a reasonable, if not amazing clip, is because of all the spending and the stimulus. So you've had all of this money coming into the system. If that got cut back meaningfully, there would be a cost to that from a growth standpoint.
Yeah, to your point, we believe a tremendous amount of the reason why our country, the US, as compared to other countries around the world, has actually done pretty well in recent years, it has been the tremendous onslaught of fiscal spending that we've...
And so take that away, and there again, there's a potentially a negative growth component that comes with that. Another topic big in the headlines right now are tariffs. And so that's something that I know you've written about or writing about in your most recent perspective letter, but it's definitely top of mind.
Yeah, there's a lot of moving parts with tariffs. And listen, we don't know what the ultimate policies will be. They're still in flux. But let's maybe talk about the short-term potential benefits of tariffs versus potentially some of the long-term concerns or costs. So starting with the short-term benefits, the main one that's been well advertised is the protection and support of domestic industries. Right? If you put a tariff on an international competitor, of course, then consumers will flock to the domestic producers.
It makes our domestic product more attractive.
More attractive. And as a result of that, not only will manufacturing be brought more onshore, but then potentially that can improve the job market as well. Right?
It can. And I think there's even a national security or self-reliance type of angle on this, where if you think back to periods like COVID, or even if we're going to get into a fight with China about different things, being able to have the things that are essential that we need onshore, there's motivations beyond just money, I think, that play into that.
COVID taught us a lot, right, about resiliency and depending on others, without a doubt. Second aspect is just revenue, plain and simple, right? In essence, a tariff is a tax. So if we can be successful in generating more revenue to help in the debt situation that we just highlighted, that can help. And then lastly, just as a broad negotiating tool, it's a tool that President Trump used in his previous administration. There's potentially some pros and cons with that, but at least the goal is to be an effective negotiating tool across trade and other what are deemed to be unfair practices on the part of other countries.
That sounds great.
Okay.
What about the potential negatives?
There are some negatives, and again, these are a little bit harder to see in the near term, but from a long-term point of view, there are a lot of concerns around tariffs. One of them is, at its core, you're really promoting inefficiency at the expense of efficiency. What I mean by that is you're supporting those very industries, theoretically, where you, by definition, have a competitive disadvantage. When you think about what's made our country so strong over decades, it's our flexibility and innovation, shifting from one industry to another, from agriculture to manufacturing to services and healthcare and technology over time. What tariffs, in essence, are doing, or will do theoretically, is hit the stop button or pause button on that and reward industries theoretically, like manufacturing, where we're at a competitive disadvantage. So there's some concerns around that.
Makes sense. I think the other issue is obviously if you're going to increase the costs to some of these things, the natural byproduct will be inflation. That's a big thing that's talked about now. If inflation's come down, though it's now ticking back up a little bit, and I think our concern is that a lot of these will be inflationary. There's
no doubt. And even somewhat related to that, counterintuitively, the very domestic industries that we are trying to support with these tariff policies, you can actually hurt them because of those very same inflationary pressures. What I mean by that is, let's just have a simple example of a shoe manufacturer domestically competing with international brands. So you put tariffs on those international brands, fine. Potentially consumers will now buy more of the domestic brand. But that domestic producer of shoes needs leather, let's say, to make its shoe product. Most of our leather is imported. And from what country do we import most of our leather? China. So now all of a sudden, the input cost for that domestic shoe manufacturer just went higher, potentially by a lot, which puts that now shoe manufacturer at a competitive disadvantage.
Yeah. And the last thing too, when we think about the tariffs that we get concerned with, is you mentioned negotiating, and if that negotiation goes awry, you can lead to some interesting trade war or very aggressive conflicts.
Absolutely, there's tremendous unknowns or volatility associated with tariffs in general. Yes.
And look, the size of the tariffs does matter too. So yes. we're painting this a little bit with a broad brush, but if the tariffs come out and they end up being modest in size
and targeted,
exactly targeted to select countries, it might not have that big of an impact. It just depends. Again, the trade war situation, things can spiral, and so I think that's one of the concern is these end up being much larger than some are hoping.
So we covered a lot. We covered the stock market, interest rate and inflationary environment, even policy unknowns and uncertainties. A lot of uncertainties that we've highlighted. That being said, on many other aspects of our investment approach and portfolio, we're very excited. We're very excited about some of these opportunities. And for one of the main reasons we're excited about them is because we feel many of these opportunities are insulated from a lot of those uncertainties.
That's very much the hope and the goal, right? Is to go and say, can you find things that are going to perform well in all environments? So in both positive and negative economic kind of scenarios. And what we've been able to do is, I think many know, we created our own fund structure last year to be able to aggregate some of these strategies. They're the private lending space, so we're in a more senior position, a more secure position than owning equities. But the flip side is that right now, especially with where rates are, we're getting paid, we think, really well for being in these spaces. And so for the risk we're taking, we feel really good about the returns that we're targeting. With, again, the caveat being that now one of the bigger benefits being if things get volatile in equity markets, hopefully these will perform well and hold up well. And if things keep running in equity markets, hopefully they'll perform well. So can you find assets that are going to do well in kind of a variety of things, because the risks that are driving them are just not the same as what are driving everything else in the portfolio.
Can you just spend a little more time giving a little bit more color on why these particular types of loans that we're making are designed to be so much more resilient than a standard plain vanilla loan?
Yeah, it really comes down to, again, what's driving it and what's the backing, what's the backup plan? Because I think a lot of standard loans don't have a backup plan. If you make a loan to a company and the company goes away, like you're in trouble. And so in this case, we like to partner with managers who have that backup plan, who say, okay, if the company doesn't work out, there are assets that we can attach to, or maybe they're focused on industries that are going to be resilient and are just outside, the broad economy, things like food or healthcare that are going to be needed in all environments.
Yeah, love that. So I'm super excited about these opportunities that we're seeing. So really enjoyed it, Megan. Thanks for this conversation today.
Thanks so much.
Thank you, everyone. If you have any questions, please don't hesitate to follow up with us and reach out to your Morton Wealth advisor.
Thank you.